Only your money on the line. Let's ask Cameron Dawson what she thinks, the Chief Investment Officer for NewEdge Wealth. Welcome back. It's good to see you.
Good to see you.
All right, so we got over this first little hurdle here, right, of 4,000 on the S&P. Yep. Been a month since we've closed above that level. We just did. Does this change your thought about this rally?
Well, I think we have to get through the most critical level, which is 4,100. 4,100 is the 65-day high. If we look back in 2022, we never closed above the 65-day high simply because we were in a downtrend. And that downtrend continued all through last year.
Is it over?
Well, let's see if we break through it first.
You got to get through 4,100 before you're willing to declare that?
Well, look, I think the technicals can get us so far.
You're a tough grader.
But the technicals can get us so far. Positioning can get us so far. We know that we started with really light positioning. But then we have to turn to fundamentals. And fundamentals, we would need to see a change in fundamentals to really think that this rally can continue.
Maybe we are on the cusp of doing that if you consider, Fed tightening, right? They're certainly near the end. They may stay where they are for a while, but they're certainly near the end. Economy looks pretty good. I mean, I know the indicators suggest that it's weakening, which of course it's weakening from a pretty strong level.
Yeah, let's start with Fed tightening, because a pause is not the same as a pivot to all-out stimulus. So to get you that 15-20% upside in the market, you'd have to go back to trading at pandemic-era level multiples, meaning 20, 21 times. Back then, money supply was growing 20%. Today, it's 0. The Fed funds rate is on its way to 5%. Today, or back in pandemic time, it was 0%. And so I think that when we think about the potential upside, we have to realize it's unlikely we can go back to those bubble multiples without that kind of support from the Fed.
So we need a rate cut. We need rate cuts to get us back to that level?
To get to those level of multiples, certainly, yes, because we never saw the market trade up to 21 times plus in the prior cycle without that degree of stimulus. So what it means is that we have to grow into the valuations that we reached over the course of 21, 22, and I think that's what caps our upside in this market.
What about the valuation where we are now? I mean, you could make a case that, as some are suggesting, you need to go to a much cheaper multiple for the market still, because earnings are going to fall off still and the economy is going to weaken still. Well, what if none of that happens? Can you justify the multiple we're at now? Some would call that a win in and of itself.
Yeah, I think that if we don't go into a recession, then it means that we likely are trading at a valuation that is in line with average, which is not too extended, but it doesn't mean that we're cheap, which gives you a big runway for upside. So I think that's where we have to measure our expectations, because as if we were trading at 14, 15 times, you'd go, even if we did have easier earnings or weaker earnings, you'd still buy into that simply because expectations are low, the bar is low.
At what point can we at least feel confident about saying we're not going back to the October lows? We have to make that decision somewhat soon, sooner rather than later, as Mike Santoli was suggesting in the prior show, right? You've got to make that call sooner or later. You either think we are or we're not.
Yeah, and I think that if we trade above that 4,100 level and kind of break that 65-day high, it would make the probability of retesting the October lows lower. But just because the October low isn't retested in the next month doesn't mean it won't be retested at some point in the next 12 months, because earnings weakness could take time to materialize. Look how strong the labor market is. Look how resilient it is. If we continue to see resilience in the economic data, maybe that earnings recession comes a little later than expected.
Or maybe it doesn't happen to the degree that people think. Maybe the economy was strong enough all along to withstand what the Fed has thrown at it, and these big recession fears don't materialize.
Or maybe if we don't have a recession in 23, could it actually increase the odds of having one in 24?
Perhaps.
If you look at consensus forecasts, it's for very low growth in 23 and then a big acceleration in 24. If that doesn't happen, this willingness of the market to say, let's look through weakness in 23, maybe that weakness shows up in 24, so the willingness to look through kind of fades.
Okay, so you're